You've probably noticed something strange about retirement. A couple earning over $100,000 a year can somehow end up paying more in taxes on their Social Security than someone making half that amount. It feels backwards, but there's a reason, and I'm going to show you exactly how it works and how to fix it. This is one of those financial rules that almost nobody talks about, even though it costs people tens of thousands of dollars. The good news? Once you understand the mechanism, you can actually control it. Most people think Social Security taxation is automatic and unavoidable. It's not. In a minute, I'll show you 5 legitimate strategies that high-income retirees use to reduce or eliminate taxes on their benefits entirely. All completely legal, but the last part changes everything, because the strategy that works best isn't what you'd expect. Let me start with the hidden rule that makes this possible. The IRS doesn't tax your Social Security based on how much you receive. Instead, they use a formula called provisional income. And that's where most people lose control of the situation. Your provisional income includes your regular income, half of your Social Security benefits, tax-exempt interest, and foreign income. That last part trips people up constantly. You can have income that's technically tax-free, and it still counts against you for Social Security taxation. Here's where it gets real. The taxation thresholds are shockingly low. For a married couple filing jointly, benefits become taxable once provisional income hits $32,000. For a single filer, it's $25,000. These numbers haven't changed since 1984, which means they've been eroded by decades of inflation. Most people don't realize they're already over the threshold before they even take their first distribution. Now watch what happens when you understand this system. The moment you know provisional income is the target, you can control it. You can control it. That's the entire lever. Let me walk you through the first strategy and you'll see what I mean. The earliest intervention point is what financial planners call the conversion window, and it opens the moment you retire. Most people think about taxes only when they're filing returns. They don't realize the years between retirement and Social Security claiming are the highest leverage window in their entire financial life. Let's say you retire at 62 but don't claim Social Security until 70. Those 8 years are essentially a tax planning zone where you control your income completely. A married couple in this position could convert $68,600 from a traditional IRA to a Roth IRA in a single year, while staying in the 12% tax bracket. The cost is roughly $8,232 in taxes. But here's the payoff: that $68,600 is now gone from future RMDs, which won't show up in provisional income calculations once they're 73. 8 years tax $68,600 equals $548,800 moved from taxable to tax-free accounts. Run this math forward when Social Security starts. That couple has dramatically shrunk their RMD requirement and the provisional income that triggers taxation on their benefits. Smaller RMD plus half of Social Security plus 0 conversions equals provisional income of $75,000 instead of $150,000. That alone can drop the taxable portion of their benefits from 85% down to 35%, or even lower. The psychology of this is interesting because it feels counterintuitive to pay taxes now to avoid them later. Most people's instinct is to defer taxes, always, but the system incentivizes the opposite in retirement, because the tax brackets you pay during conversion years are often lower than what you'll face once forced distributions start. This is where most people miss the actual opportunity. Now let me show you the second strategy, and this one has an even more interesting angle. Once you hit 70 and a half, the IRS allows you to donate directly from your IRA to qualified charities up to $105,000 per year. This is called a Qualified Charitable Distribution, or QCD. The magic part: that money never touches your tax return. It doesn't show up as income. It doesn't increase provisional income. It doesn't trigger Social Security taxation. And it can still count towards satisfying your required minimum distribution. Most people who itemize deductions never even consider this, because they think of charitable giving as a deduction issue. It's not. A QCD is an exclusion from income entirely, which makes it exponentially more powerful. Let me show you a real scenario. A 73-year-old couple has a $100,000 RMD. They're forced to take. They also give $50,000 to charity every year. Normally, they'd take the full $100,000, pay tax on all of it, and claim the $50,000 as a deduction if they itemize. If they're in the 24% bracket, that's roughly $24,000 in taxes on the $100,000 distribution, with the charitable deduction offering limited relief because of income phase-outs. With a QCD, they tell their IRA custodian to send $50,000 directly to their church and take $50,000 themselves. The $50,000 QCD never appears on their tax return. The $50,000 they take is still RMD, but now their provisional income is cut by $50,000, which changes the taxation of their Social Security benefits significantly. Original $100,000 RMD plus $50,000 SS equals $150,000 provisional income, with 85% of Social Security taxable. With QCD $50,000 RMD plus $50,000 Social Security equals $100,000 provisional income, with maybe 50% of Social Security taxable. The difference in their total tax bill between these two scenarios can be $5,000 to $15,000 in a single year. This is the part nobody notices because the benefits compound over time. If this couple lives another 20 years, the cumulative savings could exceed $100,000. And they've supported their church the whole time. This is where the psychology gets important. People feel guilty about tax planning, like they're supposed to pay everything the law technically allows, but the law itself is written to encourage this exact behavior. The QCD exists because lawmakers wanted to incentivize charitable giving without making people claim itemized deductions. You're not being clever by using it. You're using the system exactly as designed. Now let me show you where most people actually go wrong. Here's something nobody talks about: tax-exempt income still counts in provisional income. This catches almost everyone. You own municipal bonds that pay $30,000 in tax-free interest. That interest never shows up on your Form 1040, but when calculating provisional income for Social Security taxation purposes, that full $30,000 counts. You can have a situation where you're receiving tax-free income that triggers taxation of your Social Security benefits, which then becomes fully taxable. The effective tax rate on that $30,000 is not zero. It's higher because it's pushing your Social Security into taxable territory. Most investment advisors recommend municipal bonds to retirees specifically because they're tax-free, without understanding this secondary effect on Social Security. This is the trap. The moment you understand it, you can avoid it. Instead of municipal bonds, a retiree concerned about Social Security taxation might prefer to hold growth assets inside a Roth IRA, where the distributions are genuinely tax-free and don't count toward provisional income at all. Or they might use the HSA strategy, which I'm about to explain. Health savings accounts are the single most tax-advantaged account in the American tax code, and almost nobody uses them strategically. During your working years with a high-deductible health plan, you can contribute up to $8,300 as a married filer. These contributions are deductible, the growth is tax-free, and distributions for qualified medical expenses are tax-free. But here's the real strategy that nobody talks about. You don't have to spend your HSA balances immediately. You can accumulate receipts for medical expenses dating back decades. If you have $80,000 in documented medical receipts from throughout your life, and your HSA has grown to $200,000, you can take $80,000 in distributions tax-free at any time, even in retirements. The IRS doesn't care when you reimburse yourself. So in retirement, when you're trying to minimize provisional income and Social Security taxation, you can use HSA withdrawals to cover living expenses without triggering any additional income. Accumulated medical receipts $80,000. HSA account value $200,000. Age 72 distribution from HSA $80,000. Zero income. Zero provisional income impact. For someone concerned about Social Security taxation, this is like having an invisible pool of tax-free cash available exactly when they need it. The strategy requires planning, though, which is why most people can't access it once they reach retirements. You have to decide in your 40s and 50s to max the HSA and pay medical expenses out of pocket while letting the account grow. That's the trade-off. But if you can make that mental shift, treating your HSA as a long-term retirement account rather than a current year medical expense account, the payoff is substantial. Now here's the part that changes everything. All of these strategies work individually, but the real power comes from combining them strategically over time. Let me walk you through what a complete strategy looks like for a couple. Years before claiming Social Security, they begin Roth conversions during the lower income years. They're not taking RMDs yet. They haven't claimed Social Security, and they can carefully fill up the 12% and 22% tax brackets with conversions. For a married couple with a $32,200 standard deduction in 2026, they could convert up to $68,600 into the 12% bracket, paying roughly 12% in taxes, or $8,232. They do this for 5 to 8 years, systematically moving hundreds of thousands of dollars from pre-tax accounts to post-tax accounts. Then they delay Social Security to age 70, which increases their monthly benefit. Once they hit 70 and a half, They implement QCD strategies, using charitable distributions to further reduce provisional income. At the same time, they're drawing from their Roth accounts and HSA accounts for living expenses, both of which have zero impact on provisional income. The result is that when they finally claim Social Security at 70, their provisional income is a fraction of what it would have been without planning. Instead of 85% of their benefit being taxable, maybe only 35% is or less. Without planning $120,000 provisional income, 85% of SS taxable, effective tax rate on SS equals 35%. With planning $65,000 provisional income, 35% of SS taxable, effective tax rate on SS equals 8%. The person living on $100,000 per year might be paying $3,000 in taxes on their Social Security instead of $12,000. Over a 25-year retirement, that's $225,000 in the difference. Most people don't realize this level of control exists. They assume Social Security taxation is automatic, like a withholding that happens to you. It's not. It's a system with levers, and you can pull them if you understand where they are. But here's where people often miss another layer: Medicare surcharges, or IRMA-AA. Track your income from 2 years prior. The income you're optimizing for Social Security taxation purposes also determines your Medicare Part B and Part D premiums in future years. The surcharges can add $2,000 to $12,000 per year depending on your modified adjusted gross income. So when you're planning your conversions and distributions, you're not just optimizing 1 year. You're optimizing a rolling window of 3 years simultaneously. This is the part where most DIY planning breaks down. The interdependencies become complex enough that a mistake in 1 year can cost you thousands across the next 3. This is why the planning window matters so much. If you start at 62, you have 8 years to get the conversions and account positioning exactly right before Social Security claiming begins. If you wait until 70, you have effectively 0 years to plan, and you're stuck with whatever account structure you've already built. The most expensive retirement planning mistake is usually not taking action until it's too late to take action. Most people are reacting to circumstances rather than creating them. Let me give you 3 specific things to think about differently. First, your Roth IRA balance at age 70 is more valuable than your traditional IRA balance at age 70, even if they're equal dollar amounts. This alone should shift where you prioritize your conversions during the transition years. Second, the year before you claim Social Security, your provisional income is irrelevant because you're not receiving benefits yet. That's a free planning year where you can do large conversions, harvest losses, or do other income management strategies without immediately triggering Social Security taxation. Most people don't use this year strategically. One has house singo and daughter. Third, if you're married, you and your spouse can coordinate your strategies independently. Each of you can do $105,000 in QCDs per year, meaning a couple can move $210,000 of IRA money through Qualified Charitable Distributions annually, while reducing household provisional income dramatically. This coordination multiplier is often overlooked. Now let me close this by showing you what the actual math looks like for a real person. A 72-year-old couple, both claiming Social Security at $50,000 per year combined. They have a $90,000 required minimum distribution from an IRA. They normally spend $130,000 per year. Without planning, their calculation would look like this. $90,000 RMD plus $50,000 SS equals $140,000 income, minus the standard deduction leaves roughly $107,800 taxable. In the 22 to 24% bracket, that's somewhere around $26,000 in federal taxes. With planning, they've positioned their accounts so that they can take $30,000 from the IRA, $50,000 from their Roth, and $50,000 from an HSA distribution. Their provisional income is now $30,000 plus $25,000. Half of SS equals $55,000. No Social Security is taxable. Their total taxable income is $30,000. The RMD minus the standard deduction equals roughly negative $2,000, meaning they owe 0 federal income tax. They've gone from a $26,000 tax bill to nothing in a single year, and this repeats every year they're in retirement. Over 25 years, the difference is $650,000. That's not theoretical. That's the actual math. Most people who see this scenario respond with disbelief. They assume something must be illegal or unsustainable. It's not. The IRS doesn't prohibit any of these strategies. They actually encourage them through the tax code itself. Roth conversions are built into the law. Qualified Charitable Distributions have their own publication. The HSA strategy is explicitly allowed, complete with no time limit on reimbursements. The only thing these strategies require is planning before the money is distributed. Once you're in retirement taking mandatory RMDs, your optionality is gone. This is why the window between retirement and Social Security claiming is the highest leverage period of your entire financial life. If you don't use it, you lose it. You lose it. One last thing, this strategy isn't about being wealthy or having huge accounts. It's about control and timing. Someone with a $300,000 IRA and modest Social Security can benefit just as much as someone with millions, because the system is based on thresholds, not net worth. The person earning $40,000 and receiving $20,000 in Social Security has the exact same $32,000 threshold for a married couple as the person earning $200,000. The system creates the opportunity equally. Most people just don't know it exists. The mechanism is simple. Understand provisional income. Control your distributions. Use the tools the tax code provides, and plan before you claim. The relief people feel when this finally clicks is real, because it shifts the entire narrative from "I'm stuck paying taxes on Social Security" to "I have control over That mental shift is often worth more than the actual tax savings, because it removes the feeling of powerlessness. Here's what actually changes everything: you're not reacting to a system that's imposing taxes on you. You're managing income timing and account location to optimize your own situation within the rules. That's permission to breathe.